Hi there, a lot of talk lately about gold and silver moving into some kind of final paper market reset, where the quote on the screen says one thing, but the physical market is quietly saying something else. So in this video, we're going to separate the real signal from the noise, and you are going to walk away. Understanding why this metal's move is not just about price, why the biggest clue may be delivery, and why silver could become far more important than most people are prepared for. Today is Monday, May 4th, New York time. Comment below and tell me what day and date you're watching from, because in a market like this, even a few weeks can change the whole conversation. And if you value this kind of breakdown, support the channel by subscribing and comment John AG Best below. It lets me know you want calm, researched analysis, not recycled fear with a louder microphone. So here's the idea people are circling around. Gold and silver are not simply rallying, correcting, or doing another normal commodity cycle. The deeper argument is that the market is slowly shifting from paper exposure toward physical control. Not all at once, not with one dramatic headline. More like a steady change in behavior, where the people with the deepest pockets stop asking, "What is the price today?" and start asking, "Where is the metal? Who controls it? And can I get it when I need it?" That distinction matters, because a paper claim is useful until trust becomes the question. A futures contract is useful until delivery becomes the question. A warehouse receipt is useful until ownership becomes the question. And once ownership becomes the question, the conversation changes completely. Now, to be clear, I don't think every movement in gold or silver is proof of a secret collapse. That's where a lot of people lose the plot. Margin changes can be normal risk management. ETF flows can move for ordinary reasons. Traders can reduce positions because volatility gets expensive. So if somebody tells you every single mechanical change is automatically proof that the system is breaking tomorrow, be careful. But also, don't ignore the pattern. Based on recently published numbers, central banks kept buying gold at historically elevated levels through last year, even though the pace cooled from the extreme buying seen before. We're still talking about hundreds and hundreds of tons added in a single year, spread across different countries, not one isolated buyer. And gold also became a much larger share of global reserve thinking, with public reserve data showing gold overtaking the euro as the second largest reserve asset after the dollar at market value. That is not a small footnote. These are institutions that understand paper better than almost anyone. They issue it, they manage it, they defend it, they settle trade with it. So when the people closest to paper keep adding the asset that cannot be printed, you don't need to invent a wild theory. You just need to ask a simple question. Why are they doing that? Now, the balanced answer is not, because every central bank thinks the world ends next Tuesday. No, they buy gold for diversification, sanctions protection, currency credibility, geopolitical insurance, and reserve stability. But all of those reasons point in the same direction. They want something outside the promise chain, and that is the heart of the metals story. The second signal is physical delivery. For decades, the big metals venues worked because most participants were not there to take bars home. They were there to hedge, speculate, manage exposure, or roll contracts. That is normal. A futures market is not supposed to be a coin shop. But stress begins when more participants say, "I don't just want exposure anymore. I want allocated metal, I want title, I want control. I want the counterparty risk reduced." That doesn't instantly break the system, but it does test the assumptions under the system. Think of a theater where most ticket holders usually don't show up. The theater can sell a lot of tickets because it knows the historical pattern. But if attendance suddenly rises, the old assumptions stop working. The building may still be real, the tickets may still be valid, but now the seat count matters. That's the paper metals market when delivery demand rises. And this is where price can mislead people. The spot price is a reference. It's important, it's not meaningless, but it is not always the same thing as the price a physical buyer can actually transact at. During stress, coins and bars can carry premiums that feel completely disconnected from the chart. Silver eagles can move to high premiums. Older constitutional silver can get expensive. Gold products can develop wider spreads. And people say, well, spot says one thing, so why am I paying so much more? Because spot is the sign on the menu. Physical availability is the kitchen. If the kitchen is backed up, the sign doesn't feed you. And dealer economics matter here. A lot of retail buyers look at premiums and assume the dealer is just taking advantage. Sometimes spreads can get ugly, sure. But the business is more complicated than that. Dealers deal with wholesale premiums, mint distributors, insurance, shipping, fraud risk, staffing, vaulting, bid-ask spread, financing costs, and inventory risk. And the worst part is premium risk. You can hedge the metal price. You cannot perfectly hedge the premium on a coin. So imagine holding a large inventory bought at a rich premium, and then new mint supply hits the market or retail demand cools. Spot might barely move, but the premium can fall hard. That can erase a huge amount of value from inventory. So when dealers build cushions into pricing, part of that is profit, yes, but part of it is survival. And survival matters if you ever want a market to sell back into. Now let's look at the refining side, because this is one of the most misunderstood pieces. When people hear that a lot of silver is coming from the public, they imagine clean bars instantly hitting the market. That's not how it works. Public silver can arrive as flatware, jewelry, industrial scrap, shot, doré, mix lots, and strange material that has to be sorted, assayed, melted, refined, and converted into usable product. That takes time. And while that metal is moving through the pipeline, the refiner still has price risk. So they hedge. If silver rises quickly while they're short futures against incoming material, they can face margin calls, even though they're trying to stay neutral. Add higher exchange collateral requirements, and suddenly a business that is not betting against silver can still face a cash squeeze. That's the part people miss. According to current exchange margin information, silver futures require performance bonds that adjust with risk conditions. That sounds boring, but it matters because every increase in required collateral makes hedging more expensive for anyone carrying real inventory. The result can be fewer refiners willing to take new business, slower processing, and more friction in the physical market. So yes, there can be silver above ground, but above ground is not the same as available, refined, deliverable, and cheap. There is also a macro reason this story keeps attracting attention. According to public budget projections, U.S. debt held by the public is expected to sit around the size of the entire economy this year and rise meaningfully over the next decade. That does not mean default. It means investors are being forced to think harder about duration, currency risk, fiscal credibility, and the long-term purchasing power of cash. When government debt keeps expanding and interest costs keep climbing, gold does not need a panic to look useful. It only needs investors to admit that paper safety is not free anymore. And then there is the digital gold angle. Some large financial and crypto-adjacent players have also been holding meaningful physical gold behind products and reserves. That does not make every token safe. Actually, it makes due diligence more important. But it shows the same theme from a different direction. Even parts of the digital finance world are trying to anchor themselves to physical metal. That is interesting, because the future may not be simple coins versus contracts. It may be a layered market, physical coins for personal control, allocated bars for larger holders, ETFs for convenience, futures for hedging, and tokenized products for speed. Each layer has different risk. The mistake is pretending they are all the same. Now, here's where the fresh context gets even more important. Silver is no longer just a shiny inflation hedge people argue about on the internet. It is now part of the official U.S. critical minerals conversation. The final public list for 2025 added silver alongside several other materials, and the stated purpose of that list is tied to economic and national security supply risk. That matters because critical status changes how policymakers look at a material. It doesn't guarantee a shortage. It doesn't guarantee a government stockpile tomorrow morning. But it does say silver has moved into the category of strategic supply chain attention. And silver deserves that attention because it sits inside modern infrastructure. It's used in electronics, power systems, solar equipment, vehicles, defense-related applications, medical technology, and data-driven hardware. At the same time, silver mine supply is not like flipping a switch. A lot of silver comes as a byproduct from mining other metals, which means a higher silver price does not instantly create a wave of new primary silver production. That is why deficits matter. Recent silver market research has pointed to repeated annual deficits, with the market expected to stay short again. The exact number moves depending on investment demand, industrial use, recycling, and price. But the bigger point is that inventories have been drawn down across recent years. Industrial demand hit record territory recently, and even when some categories cool, investment demand can step in at exactly the wrong time for a tight market. Now here's the counterpoint. Silver bulls sometimes act like every demand category only goes higher forever. That's not true. Solar manufacturers keep trying to reduce the amount of silver used per panel. Industrial demand can weaken if the global economy slows. Retail coin demand can disappear for months if premiums get too high. So silver is not a straight line story, but it is a thin market story. Because silver is much smaller than gold in value terms, it does not take the same wall of capital to move it. When gold attracts the first wave of monetary fear, silver can sit there looking sleepy. Then once the crowd decides silver is the cheaper, more volatile cousin, the move can get violent. That's why silver often frustrates people for years, and then does a lot of catching up in a short window. So when someone says triple-digit silver, don't treat it as guaranteed. Treat it as a scenario. a scenario that needs ingredients. You need strong gold, you need tight physical supply, you need persistent deficits, you need investor interest, you need paper market confidence to weaken, you need industrial demand to stay sticky enough, and you need the public to rediscover silver. At the same time, institutions are already paying attention. If those ingredients line up, silver can move faster than people think. If they don't, the market can chop, disappoint, and shake out everyone who came in expecting a straight elevator ride. So the practical checklist is pretty simple. Watch official sector gold buying. Watch silver inventories, but don't treat every withdrawal like a countdown clock. Watch premiums, especially when spot price looks calm. Watch refinery delays and mint supply, because retail stress often appears there first. Watch margin requirements, because collateral pressure can force selling even inside a bullish long-term setup. And most importantly, watch whether large players prefer convenience or control. If they choose convenience, paper stays dominant. If they choose control, physical gets louder. That does not have to happen in 1 week. It can happen gradually, then all at once, because markets often ignore slow changes until the slow change becomes impossible to price politely. And this brings us back to paper versus physical. The paper system works when most people accept settlement, rollover, exposure, and convenience. The physical system asserts itself when people demand ownership, possession, allocation, and certainty. Neither side disappears overnight, but the balance between them can change, and when it changes, premiums, delays, regional shortages, warehouse movements, and leasing stress often show up before the final price move. Leasing is especially important. Leased metal can look like supply today, but it is borrowed supply. It has to be returned, rolled, or replaced later. In calm markets, that can be managed. In rising markets, it can become a future buying problem. So leasing can reduce pressure now and increase pressure later. It buys time, but it doesn't mine new silver. And that is why watching behavior beats watching headlines. Who is taking metal off exchange? Who is increasing reserve gold? Who is paying premiums? Who is adding collateral? Who is stepping away from leverage? Who is choosing allocated metal instead of broad exposure? Those questions tell you more than one red or green candle. If you're successful, share your success story in the comments so others can stay motivated. And also tell me this. Do you think silver is still mainly an industrial metal, or is it already becoming a monetary metal again? Because that answer changes everything. Putting this all together, I don't think the right word is collapse. I think the better phrase is trust adjustment. A system built on paper convenience is being tested by a world that wants physical certainty. Gold is already showing that shift through reserve behavior. Silver may be the delayed reaction, the smaller market that moves later but faster. That's why patience matters. Not sleepy patience, but informed patience. The kind where you know exactly what you own, why you own it, what would prove you wrong, and what would confirm the shift before the crowd wakes up. So don't root for chaos. You don't need chaos for metals to matter. A healthier outcome is simple repricing, better recognition of physical reality, and a market where people understand the difference between exposure and ownership. But if this transition keeps going, the people who only watched spot price may realize they were watching the scoreboard while the real game was happening in vaults, refineries, reserve books, and delivery queues. Thanks for watching. Keep your thinking independent, keep your risk under control, and don't let any big story replace a disciplined plan. This video is for education and perspective only. It is not financial advice, and I'm not telling you to buy, sell, or hold anything. Do your own research, match every decision to your own timeline, and remember that conviction without risk management is not strategy. It's just emotion with better marketing.